All right, well, hello everybody. Welcome back. Hope you had a productive week off of class last week and you were able to do some catching up on your reading. Now let's kind of review what's going to go on today. We're going to finish up packet number 5 and then move through packet number 6, get that completed. At the end of today, that should conclude all the information, the first 6 packets that should be included on your midterm exam. So make sure you're working on that midterm. I know it's open book. Talk to each other, talk to your friends, do whatever it takes, and get that midterm completed. All right. So let's go ahead and get back into packet number 5 and jump into the spot where we ended. This is on page 15, slide number 2. This kind of summarizes a little bit of the idea of common stock valuation. Valuation meaning how do you value the price of the stock, or is it a stock that you should buy? Okay, and there are various methods. We did cover that last time we were together. The top one here, doing the dividend discount model, and there was a calculation where there was no growth whatsoever. That would be the zero growth. That was one calculation, simple one. Constant was using the formula, and then the variable was you're using the cash flow method for the different years that the dividend was increasing at whatever rate they would have given you. And then you did the constant dividend discount model that last year, added it all together, did the cash flow method, came back with a price, and what's the bottom line? It's whatever these 2 different points here are saying. If the market price is greater than intrinsic value, it's overvalued. In other words, remember now, the intrinsic value is something that you are willing, or your client is willing to pay for that stock. So if the market price, if they're looking out there and saying, well, what's the current price? Well, the market price is 80, I'm willing to pay 70, then it's overvalued in the eyes of that individual. If the market price was 60 and I was willing to pay 70 intrinsic value, then it would be considered to be undervalued. Okay, so now when would you jump in and use these other methods that are right here? And I don't know what the order why they were put down in this particular order. The way I would attack it would be I would jump into this 3rd bullet point one here and say to myself, okay, if the company has positive earnings but paid no dividends, okay, remember now up here in the top one, the assumption was that there were dividends being paid out. Okay, so the 3rd bullet point says use the price-earnings ratio, and if the company has positive earnings but pays no dividends, then you look at the PE ratio. And when you look at the PE ratio, a couple points down here, PEs can be backward-looking or based on forecasts. It could, be aware that one-time charges can affect earnings, and you're not going to be you maybe will eliminate those one-time charges. As you're evaluating that, some of those balance sheets and the cash flow statements and all that stuff. And you are, in using the PE ratio, you might compare the PE ratio, the price-earnings ratio of the company that you're looking at, up against the industry as a whole that they're part of, and look at the PE ratio, average PE ratio, as the industry as a whole, and compare, are the PE ratios of this particular company lower than the average industry? You might, some people might take it and compare it up to the market PE ratio and come away with some type of an understanding. Okay, so in this PE ratio comparison, two benchmarks are used, and you're comparing up against something. Otherwise, you can look at PE ratios of a particular company, and what can you say about it unless you compared it up against something else? If you just compared it up against its PE ratio over the last couple of years, you could say, well, the ratios are higher than they were a couple of years ago. They could be lower than they were a couple of years ago. And you're going to walk away with some type of an interpretation from that. If you jump from that third bullet point, PE ratio, down to the PEG ratio, as on the PEG ratio, where as you can see what it says there, you take the PE ratio and you divide it by some type of an earnings growth rate. The lower the PEG ratio, the cheaper the stock. And, I guess, I don't know why I jumped onto that one. I'm looking at my numbers here, and I think I would have rather said something else right now. I'm going to back away from this PEG ratio for a second and go back to my original thought on here. Remember on this third one here, I said the PE ratio, when to use that price-earnings ratio, I said that the company has positive earnings but pays no dividends. Well, what if the company pays no dividends and has no earnings? Pays no dividends and has no earnings. Then you go to the price-to-sales ratio. If a company pays no dividends, has no earnings, then you look at the price-to-sales ratio. You can look at the historical range of this particular ratio. You can look at the industry average of this particular type of a ratio, and you're going to come away with some type of a score. So, where do you get all these? Where am I going to give you this number from? And it's off of some other reading I had once before. I don't necessarily believe they attack these ratios real heavy in the book, but they are located on pages 329 and 330 and 331 and 332 and 33. And sometimes you might have to read those pages over and over again to be able to come away with something. But it seems like whenever we're dealing with these PE ratio worlds, and if they ever have some type of a number, everywhere I read, it kind of said if the ratio was less than 1, then you would say, hey, that particular security you're looking at is undervalued. If it was over 3, you would say it was overvalued. If it was 1 to 2 in that range, it was reasonably valued. All right, now, let me stop for a second and tell you, I've never used any of these things in my career. Going forward when I'm dealing with my client, this is more advanced, in my opinion, for the stock picker, and if someone's going to be in that, if that's the type of work you want to do, and and you're going to go out and evaluate various stocks and say, I'd choose this stock over that stock. Otherwise, you know what? How much time do you really want to spend in this particular area? And I'm not saying don't learn anything about it, but I'm just saying, gee, what are they going to ask you on an exam in relationship to this type of stuff? So I kind of said to myself, if I was going to try to put a perspective on this whole page, and I want to get off this because we still have a lot of stuff to cover today, I want to kind of put it in this vein, and you can read the rest of these things on your own. But go to the top one again. But use this method, and it seems like there's always been some type of a calculation, or at least some type of a question about the dividend growth model idea on every exam that I've heard about, whenever somebody has given us some feedback on it. So when a company pays dividends, it's going to be in one of these 3 scenarios, where there was a zero growth, a constant growth, or a variable growth. Since the exam started back in November of 1991, I've only heard one time did they use the variable dividend growth model method and ask someone to do an actual calculation. It came up one time that I'm aware of, and that test has been offered enough, many times, but it did finally show up on somebody's exam. All right, so that's that part. If they go back to the next part on this one here on the PE ratio, if the company has earnings but pays no dividends, look at the PE ratios. If the company, on the price of sales, if the company pays no dividend and has no earnings, maybe use the price of sales ratio. And that's about it. You can look at the rest of these and see if you want to come away with anything. And let's move away from this page. Don't like this page that much. How is the dividend growth rate calculated? You can read this through. It's pretty, kind of explains some of the things that were talked about in the last couple of days. The efficient market hypothesis and valuation techniques, again, more theoretical type stuff. I won't lose any sleep over it. I don't think you should either. I don't even know who this Mark Carhart is down here. In the four-factor model, I don't think he's in the book. This might have been just an addition from the author of this slide. Let's move off of this. Let's get to this part about 5 ways to calculate earned returns. You might say, oh, this is pretty simple stuff. I know how to do this stuff. I can do the arithmetic return. That's good. Not saying you can't. We know that calculate the simple average is easy. You add them up and divide by the number of parts, but look what that second bullet point. It's never accurate. Only worth discussing because clients like to use the average return. So I think the only way that we could really stress where we're going to go with this particular, this slide in particular, would be because we're looking at slide 17-2. Let me give you an example of why arithmetic return is maybe not always the best one. So here's what I want you to do. Let's see, delete the page, new page. All right. Let's say you had $100. And then at the end of the first year, it grew to $150. So what type of return did you have here? You had a plus 50% return on your money. At the end of the second year, the stock it dropped to $75. So you lost 50% for that particular year. Okay, so what was your average return? Okay, well, you would go plus 50 minus 50 is 0. 0 divided by 2 is 0. Your average return is 0. Now, tell me, you're telling your clients, you gave me $100. At the end of the second year, you've got $75 in your pocket, and I'm telling you the average return was 0. That pretty well, I think that I would be fired at that point, and so would you. Okay? So you really, because what happens, the arithmetic return doesn't account for, it's kind of has a biased upward. You should do what they would call a geometric average on this one, not an arithmetic average. And one of the things you want to take away is that the arithmetic return is usually higher than the geometric return. Okay? And that the arithmetic return does not account for the compounding effect. So how would you do this using the compounding effect, the geometric average? And it would be the following. You take 1 plus the return, so it's 1 plus the 0.50, which equals a 1.5. and you're going to multiply that times 1 plus the return on the next one. Well, that was a negative 0.50. Okay, which would be then a 0.5. Okay, so 1.5 times 0.5 equals what? It equals a 0.75. And you're going to take the nth root. There happen to be two parts, so if I put a 2 inside of here, we're taking the second root, which in essence is taking the square root. If you can recall on how you do that, it would be 0.75, take the 2 and put it as a fraction, which is 1/2 root. Okay, and you might say, well, wait, I can't use a 1/2 root. Okay, then you take that 1/2 root and you put it as a decimal, which is a 0.5. Okay, so in essence, if you're using your 10B calculator, it would be a 0.75. Hit your gold button. Find your y to the x button. Put in your 0.5. Hit your equal sign. And you come up with a point. Come up with a 0.8660. You got to remember that since you did this 1 plus the return over here, you must subtract 1 from that number. And you come up with a negative 0.134. If you multiply that times 100 to move the decimal point 2 places to the right, your answer is a negative 13.4% return on your money. Okay, that's how you do the nth root approach. Now, could we have done it a different way? Could I have just done a time value of money approach? Let's see if we can do that. $100, change your sign present value to N. 75 is a future value, solve for I, and you come up with a negative 13.3975, which is negative 13.4. All right, so I showed you 2 different ways of attacking this, one verbally and one in writing on the front. You can see why the arithmetic mean would not be an appropriate measurement for this particular scenario. And going back to that slide, going back to the slide here, arithmetic return, where they tell you that it is never accurate, only worth discussing because the client will use it since it's easy to calculate, but you understand that it didn't make a lot of sense in that particular case to say that you have an average return of 0 when you actually lost $25 over that 2-year period of time. So you go ahead and do a geometric average. I showed you the longer method to do the geometric average, where you take 1 plus return times 1 plus return and then take the nth root. And I did that for a reason, because when we do another problem coming up pretty soon, you're going to see why that comes to play pretty well and how it fits a little bit better. And then when we did the geometric error, we came up with that negative 13.4. Okay? So having said that, let's go to holding. You know what? I want to jump off of holding pre-return for a second. and go to this geometric average, and we'll come back to holding period return. Because I think the flow would be better at this point. On the geometric average, as you can see, the first bullet point up here states that it is designed to correctly punish negative years when calculating the returns. In other words, it illustrates the returns that include negative. I don't know if I like the word punish negative years. I like to say, hey, geometric average illustrates returns that include negative years returns. Okay. I had mentioned to you, here's your steps. Take each of the period's outcomes and convert to a decimal. Okay, so if they had a 50% gain, it would be a 0.50. Add 1 to each result, so 1 plus that particular result, multiply them together. All right, and here they're showing you use it by doing the present value, future value to get to that particular answer. Okay, all right, let's take a look at the next slide, which would be page 19-1. And look at the scenario that they presented here. Assume the client's performance over the 5 years is 25, negative 25, 10, 40, and a negative 10. The arithmetic average is 8. Do you agree with them that the arithmetic average is 8? All right. Does anybody remember how to do an arithmetic average using the single plus buttons? How about a green arrow? A green check says, yeah, I know what you're talking about using the single plus method. A red X says, I have no idea what you're talking about. Green check says, you know what I'm talking about. Red X says, what are you talking about? Okay, we got a couple of what are you talking about. All right, I'm looking at this particular part down here. Sorry, let's stay up here with I want to know the arithmetic average. They said the arithmetic average was 8. Okay, so how would I have done that arithmetic average? The following method. Whatever you're trying to average out, you always want to put in first. All right, so 25. All right, 25. Hit your single plus button. I could put a 0.25. It's going to come out the same as an answer because it's all proportionate in the way it's done. So now let's do that. Let's go with 0.25. That might make it easier since we had a plus 0.25 up here at the top. Hit your single plus button. The single plus button on the 10B2 calculator is in the 4th column, 3rd row, right next to the arrow button. It's got that sideways sigma button, which means summation. And your display window should show a 1.0 on it. Then we're going to go and put the next one in. We're going to put in a 0.25, hit your change sign button so that you get the negative in front of there. Okay, hit your single plus button. Your window should show you a 2. 0.10. Hit your single plus button. Display window should show a 3. 0.4. Hit your signal plus button. It should show a 4.0 in your display window. And last but not least, 0.10. Change your sign button. Make it a -1. Signal plus. Hit your signal plus and it should show a 5 in your screen. When you got all that in there, then all you're going to do is go ahead and solve for your gold. '7 button. Gold 7. because underneath your gold 7 button is the X with the line above it, which stands for arithmetic return. Did you come up with 8 as an answer? If you did come up with 8 as an answer, give me a green check. I got one of you that did. Come on. Anybody else get a... Okay. All right, so we got a 0.08, right? Which is the answer for arithmetic average. By doing it this way, just remember one thing, folks. When you're doing it this method, the sigma plus method, if you hit your gold 8 button, you'll come up with a standard deviation. The standard deviation for gold 8 would have been 26.1247. If you hit your gold 9 button, you're coming up for the standard deviation for the full population. Remember, if you ever go gold 9, your number will be higher than gold 8. Excuse me, they'll be lower than gold 8, because gold 8 is using a lower denominator. N-1 is what is being used in the calculation for standard deviation in gold 8. In gold 9, it's using the N, which is a higher number, because you didn't subtract 1 from that N. So that's just a backtrack. All right. Now, let me erase what I just did there. And come back and look at this method of doing the geometric average using the method that was discussed, which is take the 1, add it to the return. So 1 plus the 0.25 is a 1.25. 1 plus the negative 0.25 is a 0.75. And you come up with this particular scenario. And then, as you can see down here on the bottom, they have a 1.299. Right? So, if I ask you this question without you using your calculator, if I gave you $10,000 without using your calculator, if I gave you $10,000 and you got those 5 years worth of returns, how much money will you have at the end of that 5-year period of time? Don't use your calculator. Look at the board. Come up with a dollar amount. Dan says $12,990. Does everybody agree with Dan? If you agree, give me a green check. If you don't know, give me a red X. Kind of wondering, how did Dan get that 12,990? Okay, so we got one with the red X and a couple with the greens. The bottom line is, see this number right here? That 1.299. If you take 10,000 and multiply it times 1.299, you'll come up with $12,990. Okay, because what that is it's a summation of all the returns at the end of a period of time. If you took that if we took that 1.299, took the nth root of it. There's 5 parts here. 5. Take the 5th root of 1.299. What do you do with that? You get rid of the radicand. Take your 5, bring it over as a fraction. 1/5. Can't use 1/5, so you convert the 1/5 to 0.20. So you can take that and the way you would write that out, if you were, it would be 1.299 9, hit your go button, find the Y to the X button, and the Y to the X button on the 10B2 is located right underneath your time sign. Put in your .20, hit your equal sign, and you come up with a 1.0538. Subtract the 1 from that because you added 1 over here. Remember, these are all being added. So now you're going to subtract the 1. And you come up with a 0.0538. If you multiply that times 100, you end up with 5.38%. Compound rate of return, geometric average. They did what they did for you. Here, as I said, let's go a different route. Okay. They said, well, if we started with $1 and our future value was 1.299, and we had a 5-year period of time, and we're in 1 per year compounding, you'd come up with 5.38. So there's always 2 ways, a lot of times 2 ways of skinning the cat. This here is a time value method in red. Over here was using the nth root geometric approach. You had to do some of this stuff right here, to get to this, but you do the same stuff to get to that answer down here. So it's a matter of how you want to attack it and how you want to get to the geometric average. Find the easiest way for you, as long as you can stay consistent. It should work out basically all the time. If you use the time value of money approach on your calculator, that does give you the geometric average return. There is another way of skinning the cat by doing the nth return, but you need to learn a few more keystrokes to get to that. So whichever way you want to get to it, it's up to you. Alright, so now let's go back, if we could, to that holding period return. And on this holding period return, and this is on page 18-1, some of the key things to remember about the holding period return: it does not take into account the time frame that generated the return. Holding period return for a 1-year period of time would give you the total return for that particular year. But second bullet point says the holding period return would overstate the return on the assets if the assets are held over a year. Okay, so you might be going, all right, so what are you saying to me? Okay, well, I'm going to say to you the following. Let's get a new page, and let me give you a scenario. Here's the scenario. Okay, you might want to write this down, and then I want you to do the calculation for it. Let me change the colors in here and get the black back up here. All right, here we go. Okay, you buy one stock for $15. You sell it for $34. you earned a $3.40 dividend. So my question to you is, what's the holding period return for 1 year? All right, well, so you're going to go to, and you say, okay, well, if I take the formula, which was P1 plus the D minus the PO divided by the PO, which is equal to the P1, which is the ending period, $34. I add to it the dividend of $3.40. I subtract from it the PL, the starting price, which is $15, divided by that $15. You get what? $22.40 in the numerator, divided by 15, comes up with a 1.4933. If you multiply that times 100, you have 149.33% holding period return. Does everybody see how that works? If you do see how that works, give me a green check. Pretty black and white, isn't it? All right. So now, hold it for 2 years. What's your answer? Same scenario. You only earned the $3.40. You earned a $3.40 dividend during the time period, and it was 2 years in length. What's your answer? And the answer is, it's the same. So how could you have the same answer for 1 year and 2 years? And that's because if you go back to the statement, holding period return, this one right here, holding period return overstates returns for assets held over a year, but is accurate for assets held 1 year or less. All right, so having said that, what would be a better way of coming up with what kind of return did you get? And the answer would be, do a internal rate of return calculation for this. So how would you do an internal rate of return calculation for this? The way you do an internal rate of return calculation would be the following. You say to yourself, okay, I started at $15, so I've got a $15. I'm going to change my sign, CFJ. I'm using my 10B calculator. At the end of that first year, or excuse me, in the backtrack, that was the original output of money. So that's when you put that in there for the first time. And if you ever looked at your screen would have said, if you took your finger and you push down the button on that CFJ, 15, change your sign, CFJ, and you held down that CFJ sign or button, your screen would have showed you the letter O, CFO, like that, which means your original output of money. When you take it off, it'll show you something different, but that means point in time 0. You earned a $3.40 dividend in the first year, okay? So you would put down $3.40 CFJ. You don't change your sign because you didn't spend the money. You received the money. If you looked at your window, it would have a CF1 because that's your first period of time. At the end, you put down $34. Hit your CFJ button. So if you held down your screen, it would have said that was your second period of time. If you drew your line and solved for your gold button, IRR button, which stands for internal rate of return, that's located in your third column, third column, second row, under the CST button on the 10B2 button on your 10B2 calculator. And you should come up with an answer of 62.31%. Did you all come up with 62.31%? If you did, give me a green check. Okay, looks like we got a couple of you that got a green ones. Why wouldn't the third hour be part of the CF1 number? Okay, this calculation that I was doing was for the 2-year period of time, not the 1-year period of time. Because remember, when we did the 2-year period of time holding period, the answer was 149.33, and you said, well, it can't be 149.33 if my holding period return for 1 year was 149.33, and that's the problem with doing the holding period return by itself, is that it's good for 1 year. If it's greater than 1 year, it's going to overstate. If it's 1 year or less, it'll give you the true holding period return. So if it is a longer period of time, you can't use the holding period return. You must go to the internal rate of return method. Okay, so now the question is, what does 62.31 represent? It's the internal rate of return. I'm going to give you the definition for internal rate of return. This definition came actually out of the book from the Hewlett-Packard 12C calculator book. When I bought my HP 12C calculator back in the early 80s, we got a booklet. Well, you know what? I know that you got a booklet for your 10B. It probably states it in there too. And the definition for internal rate of return is the following. Internal rate of return is the rate of return at which the discounted future cash flows equals the initial cash outlay. The internal rate of return is the rate of return at which the discounted future cash flows equals the initial cash outlay. So you might be saying, okay, well, what does that mean, really? It means the following. If I took this $34 as a future value, so $34 future value, 2N, because I'm dealing with the second year. That $34 was the end of the second year. Okay, I use 62.31 as my I, and I solve for the present value. The present value of that number is $12.91. If I took this $3.40 as a future value, my period of time is 1N because that was at the end of the first year, and my I is 62.31. The PV of that number is, I'll bring it up here, is $2.09. Add the 209 plus the $12.91, and you're going to get your $15. So let me say it to you again. Internal rate of return is the rate of return at which the discounted future cash flows. So all you did is take those future cash flows and bring them back to the present. And it'll be equal to the initial cash outlay. That's how you would define internal rate of return. I read in a book recently that they said that the internal rate of return is also the compound rate of return. It's also the cap rate. Okay. It's also the yield and maturity rate. Okay. I say that with tongue-in-cheek because sometimes it will be exactly those numbers. And so, why couldn't you say it's those numbers? And this one book says you can say it's those numbers, or those expressions of returns, or rates of returns. Okay, and I say, okay, I'll accept it because I read it. I guess everything you read is supposed to be true. But at one time I used to say, you know what, I would never want to say that internal return was always going to be the same as a compound rate of return, even though it seems like it works out many times. Could it ever be different? And the answer is, I don't know if it could be different, but I just never wanted to say it with conviction until I read it. And I only read it for the first time about a couple months ago, and I've been teaching this for 30 years. So why did it take 30 years for me to read it somewhere? Don't know the answer to that. All right, anyway, that's how you do the internal rate of return method. It's called the cash flow method on your calculator. You're using your CFJ buttons. If I did this on a timeline, okay, this is a timeline. Point in time 0 was the original outflow of money. I spent $15 to buy that stock. 1 year later, one time period later, there was a $3.40 dividend paid. The second time period, the stock was selling at $34 a share. Okay, so then you take and if you put this into the internal rate of return method, you go $15, change your sign because you spent the money, and on the timeline I showed it. I put the money that I spent below the line, money I received above the line. So $15, change my sign. C of J represents 0.0. That's your starting point. So that represented 0.0 in time. You put the $3.40 in. Don't change your sign because you didn't spend it. Hit your C of J button, and you just inputted what was ever located in the first time period. Take your $34, hit your C of J button because that's the second time period, and that represents, so you never skip a time period when you're doing the cash flow method. And also, you've got to remember that if there's ever two things happening in that time period, like for instance, you might have received a $3.40 dividend, but what if you bought another stock for $20? Well, $3.40 money coming in, $20 money going out, net that number as a negative number. You know, what was the cash flow that occurred during that time period? So always net out what happens in the time periods. Never skip a time period. If there's nothing in the time period, use a 0. Always have to have something for every time period. We'll do some more of those cash flow method calculations down the road. And then you saw for the gold IRR button, and that's where you would have come up with that 62.31. So so when the numbers of shares and dollars invested is different each year, the only way to appropriately determine the rate of return is what they say, do the dollar weighted return. Dollar DWR, the dollar weighted return, also known as the internal rate of return method. So dollar weighted return is the same as the IRR. It is different than the time weighted return. Okay, this is not the time weighted return. This was the dollar weighted return, the internal rate of return. Your client likes the dollar weighted return. Your client likes it. They say, how did my money do? The investor is concerned about the return earned on all of their dollars invested. The dollar weighted return would be the best way to present the return earned. But if you are a money manager, you don't want to use that dollar weighted return because you cannot control the investors giving you more money and saying, well, hey, you did such a great job, here's an extra $1 million, and now you have to buy into a market that's overpriced, and you don't really want to buy in at this point. Or a client who comes in and pulls out $500,000 and you only hit $200,000 in cash, well, now you have to liquidate $300,000 worth of securities to be able to give them their cash that they want. So the money manager likes the time-weighted return method. They like the time-weighted return method, and we're going to do a time-weighted return calculation in a second. All right, let's move off of this. We did geometric average. Here's that little discussion on the internal rate of return. That's on page 19-2. We've kind of talked about all this stuff here. You know, they bring up, hey, you know, when in doubt, always draw yourself a timeline, which I kind of did on that one example. You know, use this dollar weighted return, as I say up here, or internal return, dollar weighted return means the same thing, okay? Use it when the person is asking, how did my money do? They have control over the inflows and outflows, not you, not the money manager. And you can read the rest of these different things associated with that. All right. Here's an example of the internal rate of return that they have in your book. Let's take a look at the client invested $11,000 into the mutual fund. Notice it's below the line. It's at 0.0. 6 years ago. Invested another $6,000 2 years after that. Okay. So what do you know? What do you notice about? Okay. Your $11,000 is your point in time zero. There's nothing here for the first year, so I'm going to tell you, make sure you put in the zero. $6,000 was invested 2 years after that, so that's $6,000. Notice how they changed the sign here. Year number 3, nothing occurred here. Nothing occurred either in or out in years 3, 4, and 5. So they put in the 0 CFJ for this third year right here. That's that one. And then they use a new method that I haven't shown you yet. I'm going to show it to you right now. You could, on your calculator, if you find your NJ button, and the NJ button is located right below the CFJ button. And the only way to get to that NJ is, of course, push the gold button before you hit that NJ button. And all this is saying to you, after you put in the 0, is you're saying, oh, calculator, please repeat my most previous entry a total of 3 times all-inclusive. I'll say that again in English. Oh, calculator, please repeat my previous entry a total of 3 times all-inclusive. So that means I put in the 0, then I go into the CFJ, I hit 3 gold NJ. It says repeat the previous 0 a total of 3 times all-inclusive. So there's how many times is 0 in there? 3 times. Did you have to do it that method? No. You could have gone 0 CFJ, 0 CFJ, 0 CFJ if you wanted to. Or you could do it this way. And then this last but not least, the 6th time period. Remember I mentioned to you about netting it out? 23,400 was the worth at the end of that 6-year period of time, but they had also sold $4,000 in that particular year. So there's the total amount of money that came out in that year was $27,400. You net out what occurred in that year, and that's what's shown right here. And you hit your goal IRR. So practice makes perfect on how to do that particular type of a calculation. Last calculation for this assignment is the time-weighted rate of return. It's the, look at the second bullet point. It says its focus is on the percentage change that ignores the dollar amount invested. In other words, it's the money manager saying, how well did my choices work? What were the returns for those choices during the various time periods that we're looking at? Okay? That's what's being said there. Okay? Now, how do you get that? It's a combination of using the holding per return and the geometric average to get it. All right, so you can look at the different statements here, but let's go to a white page. Let me give you an example of an actual test question that was used on the comp exam, and you had to solve for it. This was an actual comp exam question. All right, and it goes like this. You buy one share. And I want you to write this down because you're gonna do two calculations on this one. Buy one share of stock for $40. At the end of the year, you buy one share at $45. All right, so you bought a share to begin with. At the end of the year, you bought another share for $45. At the end of the second year, you sold both shares for $52 each. In each year, you received a $1 dividend per share. Each year you receive a cash dividend of $1 per share. Okay? So my question to you is the following. What is the dollar-weighted return? And what's the time-weighted return? Go ahead and solve for it. My question to you as you're starting to solve for it, if you're totally lost, give me a red X on how to do dollar rate of return. If I get one red X, I will do it on the board right for you right now. Okay, you're working on it. Good. Anybody have an answer? Just for how about the dollar rate of return? Let's get that one out of the way. All right, so Heather has a internal rate of return of 16.8284. You got it. Which is another way of saying 16.83. Good job. Time rate of return. Anybody getting close to it? Okay. Anybody have any problem on that time rate of return? You see what we did? We'll take a break right after this particular calculation here. Time rate of return should have been at 16.38%. You had to do a holding period return for the 2 time periods. Bought a stock for 40 in the first time period, got a $1 dividend, and it was worth 45 at the end of the first year. So you come up with a 15% return for the first year. Second year, stock was worth 45 at the beginning of the year. You had a $1 dividend, sold it for 52. Come up with a 17.78%. 1 plus return times 1 plus the return, take the nth root of it, come up with a 16.38. So you got a dollar rate of return of 16.83 and a time rate of return of 16.38. You got to say to yourself, do I really need to know this? The answer was, this was an exact question on the exam. The bottom line is they could ask you to solve for something like that. Yes, you do need to know it. Anybody have any questions about it? If not, we'll take a 5-minute break. And we'll finish up one more slide or so on this assignment, then we'll go to assignment number 6. You don't add the 2 together on time rate of return. It's 1 plus return times 1 plus. You got 2 different time periods. So it's 1 times 1 plus 0.15, which is 1.15 times 1.1778. There you go. All right. All right, 5-minute break. I got 6:39, so at 6:44, we'll start talking again. Okay, very good. All right, here we go. Let's take a look at page 21-1. And all I want to do is point out a couple key things on this. They talk about index weighting and calculation methods, okay, for this particular page. And your takeaway on this, first of all, these items are broken down in your Mayo 11th edition right around was it page 363 or so? I think. Let's see. Is it on 363? These things. And you might say to yourself, well, what do I got to know about this stuff? 360. Let's double check and see if that's the page that we hit it on. It's 363. Yeah. Other indexes of aggregate stock prices, they talk about the S&P 500 there, and yeah, all right. So the easy way to remember all this stuff is the following. You see the first one, the capitalization weighted average. They use a value weighted approach. Just remember that every index uses this method. Every index uses this method with the exception of 2. The 2 would be the price weighted is the Dow Jones method, and the equal weighted geometric average right here in the bottom is the value line index. So value line index uses the equally weighted geometric average approach. Price weighted is used by the Dow. All the rest are using capitalization weighted average return. All right, so that's one takeaway. Second thing, on the capitalization weighted up here on the top of the page, how do they do this? Capitalization, number of shares times price per share, is calculated for each stock in the index, and then it's divided by the total value of all the stocks in the index. So total value, dollar amount of all the shares, the total value, dollar amount of all the shares of all the stocks that are in the index divided by the total number of shares would give you this particular index. And assume that there had to be a starting point somewhere, and and let's make it simple. If they gave you a base number of 100, and at the end of the year you did this calculation, and the new number is 110, you would say, let's see, 110 at the end of the year. I started at 100 at the beginning of the year. I had a 10% growth for that particular year. What if I started at 100 and it was and my value was 95? I would say I lost 5% for the year. Okay, so every one of these had a base at some time. You don't have to know when did it start. That's not irrelevant at this stage of the game. Just they had a base. So when you hear the Dow is up 44 points, okay, what from yesterday's close of so it's up 44. Well, what does 44 points mean? If they if they put it in a percentage, that's one thing. Well, how big is the Dow right now? 15,000, 16,000 points. So get yourself a feeling for how these things are all taken into account. One of these things I don't like. Look at this one down here. I think there's something wrong with the first bullet point under equally weighted geometric average. If we're talking about an equally weighted geometric average, look at this explanation here. Share price percentage changes added and divided by the number of stocks in the index. That's an average return. We don't want an average return. We want a geometric return. So I don't know why that statement is made that way. So I would prefer you to learn it this way. On the value line index, there's 1,700 shares on that value line index. Okay, if there's 1,700 shares, how do they come up with a number? I'll tell you how they come up with a number. They take the share price. Let's see. Okay. They would take the share price in the value line index. Let's say the share price was 10 on one of the stocks. The next stock was $12 in value. The next stock that they're looking at is $44 in value. The next stock they're looking at was $6 in value. So on and so forth. You multiply the share price of each one of the stocks on the value line index, 1,700 of them. So just imagine the number you're looking at. It must be a yard long, that number. And then you take the 1/1700th, okay, whatever that number is under here that you would have gotten. Then you take the 1/1700th root of it, which is 1/1700th. Find that decimal, and then do your gold, the gold y to the x type of a calculation. That's how the geometric average is done on the value line index. Stock price times stock price times stock price times stock price, and that gives you the geometric average return. That's all it is. All right, so I just think that what you see on here is wrong. Maybe you need to go. Maybe they're saying, hey guys, you could do it either way. You could do a average return for the equally weighted, or you could do a geometric average. Well, why would they call it the equally weighted geometric average and then tell you to use the average definition. So I think there was a little confusion on that. Don't lose any sleep over it, but be aware of it. Now, so what is your takeaway from this slide? Number one, there are 3 different index weighting methods. Every one of them uses the value weighted, with the exception the Dow uses the price weighted, and the value line uses the geometric average. And then the other takeaway would be learning, like the second bullet point here. They say that the larger capitalized stocks have more influence than the smaller capitalized stocks. They tell you that in the price weighted, the higher price stocks have more influence over the lower price. But on the equally weighted one, the second bullet point is that they say small cap stocks are given as much influence as the large cap. So it's just a matter of understanding when to use it, why to use it, how to use it, what it's supposed to try to represent for you is the takeaway on this particular page. You know, there are times where you hear about the S&P 500. Oh man, and the S&P 500 was up 33.4% for the year. And then you look at the 500 stocks that we're using there, and only maybe 8 stocks had great years. The other 492, out of the 492, maybe 300 had lousy years. 192 had average years. And there were 8 big ones that carried it because they were the biggest stocks in the index. You know, so is the S&P 500 a great index to use? And the answer is, well, it's a good representation for blue chips, as they say. Are there better ones? You know, it's a matter of opinion. Just use the appropriate one that's appropriate for the portfolio that you're putting together. And what they're saying is that if you are putting together a blended portfolio, a diversified portfolio, that you will use potentially different indexes as the target benchmark that you're going to evaluate your security or your fund up against, and have a blended return type of thing. All right, so that's that. And the last slide for this particular assignment was this dollar cost averaging. This is on page 21-2. What is the average price paid for a mutual fund share under the following example? What's the idea of dollar cost averaging? You're spending the same amount of money each time period. What changes each time period? The prices per share in this particular fourth column here. Third column, excuse me. Under the shares purchased, notice that if the price was $10 a share and you spent 1,000, you got 100. Price went up to 12.5, you got fewer shares. Price went down below $10 a share, you got more shares. So the bottom line is that on dollar cost averaging, it's an unemotional way of investing. You're spending the same dollar amount, and you're coming away with it says to get the correct answer of $10.99, you need to extrapolate each purchase so that the total dollar value is invested 5,000 divided by the total shares. All right. So what are they saying here, folks? The following. They're saying if you can come up with the total dollar value divided by the total number of shares, so 5,000 divided by the total number of shares of 455.01 shares, you'll get the average share price. Okay? Simply averaging the prices, you don't just take the prices, add them up together and divide by 5 to come up with an average share price. No, that's not the way you do it. You got to do it total dollar value of the portfolio divided by total number of shares. Is there another method on this one? Sure. Let's clear the page for a second. And you could have gone the following. If we're doing the average cost per share, you could have said, give me $10. Okay. Hit your input button. 100 shares, Sigma Plus. Your display window is going to show the number 1 on it. 1250, input it. 80, Sigma Plus. 1111, input it. 90.01, Sigma Plus. 16.7, 60. Sigma plus 8. Inputted 125. Sigma plus. Now, because you did this method with the you go to your gold button and your number 6 button. Because your number 6 button has an X with a line above it and a W, which represents the weighted average return, or the weighted average cost, weighted average share price. So gold 6, and you'll come up with the same number of 10.99. So what you have to remember, if you're going to go with this method with the input and the Sigma plus button, whatever you are weighting, you want to weight the share price, goes in first. What are you solving for goes in first. You're solving for the weighted average share price. Okay? Now, here is an example of dollar cost averaging. Write down the following. You better make sure you know also how to do share averaging. We don't have time to cover share averaging, but the idea behind share averaging is buying the same amount of shares each time period. You probably should also know about value averaging. Because the CFP board at one time talked about you should know the different averaging methods. Well, there's dollar cost averaging. All right, so I'll put on the top here. The previous slide did dollar cost averaging. Learn about share averaging. Averaging, there you go. Value averaging. And how about averaging down? I'd look those things up to make sure I learned about them, okay? If I were in your shoes. If we get through all these assignments, and then our last day, when we're doing a little bit of review, for, in essence, you can ask any questions you want. If you want to come back to those things, we can talk about those things in particular. But I want to make sure we get through. We're at 7 o'clock already, and don't know how we're going to get through this next assignment in an hour, but we're going to hustle. All right. Nothing else to say there. So let's do the following. Down here to packet number 6. All right. If you can turn to packet number 6. Packet number 6 gets in talking about the macroeconomic environment for investment decisions, behavioral finance, technical analysis. All right. I'd like to skip this first particular page here. We'll come back to it and jump into 2-1. Let's just talk about inflation for a quick second. It's defined as an increase. First bullet point up here. It's defined as an increase in the general price level. Maybe another way of saying it is it's defined as a continued rise in the average level of prices. Continued rise in the average level of prices. It does not mean that all prices are rising. To have an inflationary time doesn't mean that everything in the world is going up in price. Most things are. They're not going up equally. Okay. And so another way of looking at it is that each dollar of income will buy fewer goods and services, because of inflation. Okay, how is inflation measured? By these different CPI, PPI, GDP, so on and so forth. Right? We're not going to sit on any of these. You could read about those types of things. This third bullet point about too much demand can impact or inflate. You know, too much demand pulls what? Up the price? Too many dollars chasing too few goods? You know, if there's only a few out there, people are going to say, I'll give you $40 for it. Someone will say, I'll give you $41. Someone will say $42. I'll give you $50 for it. Almost like an auction, right? If the demand is greater and there's more dollars chasing fewer goods, that could cause inflation. How about this cost and push and all that stuff? A lack of supply pushes the prices up. The opposite would be an abundance of supply could push the prices down. All right, so if we push up the price, real or perceived shortages of one or more factors of production could cause this to happen. You know, in the do you remember, for those of you who can remember, about Cabbage Patch dolls? Oh, when was that? That might have been 25 years ago. These Cabbage Patch dolls are around 25, 30 years ago. And, you know, everybody wanted a Cabbage Patch. You go to the store and there were only 30 on the shelf and they were gone and people were all upset and all that type of stuff. And then the next day, the 30 showed up. You know, what a great ploy, to just put out so many. People come back the next day, they want to buy it. They're back in the store, they're buying other things, So there could have been a perception, like that says, a perceived shortage of one or more things happening out there. Just a thought on that. All right, so inflation, know the definition of it. That's good enough. How about for deflation? Deflation is defined as the decrease in the general price level price level of goods and services. If we're in a deflationary type of a situation, would preservation of capital be a primary concern for people? And the answer is yeah, probably. If, one of the things that you're learning about certain terms, but you've got to relate it to investing a little bit also. Okay, so as an example, would you avoid lower quality bonds in deflationary times? Probably. You probably would consider buying into higher quality debt. Well, what do you mean by quality? Well, when we get into doing assignments 7 and 8, and we're talking about credit ratings on bonds, your AAA, AA, single A, and triple B investment grade bonds, AAA, AA being those high quality bonds. High quality bonds don't pay as much of an interest rate as compared to a high yield bond. And what's a high yield bond? Well, a high yield bond is something that is double B or lower. Okay, those are things you're going to need to make sure you learn about as you get into the bonds, and that's what I was referring to when I said that in a deflationary time, maybe avoiding the lower quality bonds and you should maybe consider buying higher quality bonds might be appropriate. What if we're in mild deflation? Mild deflation, maybe you're looking at defensive common stocks. Well, first of all, what's a defensive common stock? Well, a defensive stock is what? A stock that is a stock associated with a company that offers goods and or services that people will need at all times, like food, drugs, milk. Even if we're in deflationary or inflationary times, you're still going to be buying that milk, right? All right, so that's the idea behind it. So what am I concerned with? We had inflation, now here's deflation. I'm going to jump down to disinflation. What is the difference between disinflation compared to deflation? Disinflation, stages where prices continue to rise, but at a falling rate. Who comes up with these words? Disinflation. Let's see, we got inflation. Inflation is defined as an increase in general price level, a continued rise in the average level of prices. But if we're in a disinflation, which sounds like it's the opposite, but it's not, it says, hey, we still are in an inflationary mode, but it's not rising as quickly. So they call it disinflation. Okay, look at the second sentence here. Disinflation is often confused with periods of time when prices actually drop. Typically occurs during strong economic times. Right. Disinflation is often confused with periods of time when prices actually drop. If prices are actually dropping, isn't that deflation? Disinflation is prices continue to rise. So they're saying, don't confuse that. Disinflation is it's still going up, but not as quickly. Deflation is that it's coming down. Now you might say, well then what the heck is stagflation? Hey guys, stagflation, 30, 40, 44 years ago, somebody came up with stagflation. It's a term describing rising inflation coupled with slow economic growth. It was there was an economic slowdown back in the 70s, but oil prices were going up. Right? There's an economic slowdown, and oil prices were moving up, and kind of like moving in an inflationary upward movement. So someone coined the statement stagflation. We haven't had a period of stagflation. Will we ever have another period of stagflation? And the answer I heard in the comments say, oh, maybe, who knows? And if it is, someone will coin it and say, hey, this is stagflation. This is what happened 44 years ago. Well, who gives a darn sometimes about what happened 44 years in regards to a new term to scare people? Or is it just saying, hey, I know I'm a believer in, you should learn about history and learn from history a little bit on what they did to change or to improve on it. Does history repeat itself? Oh, you can always make well, who knows? Does history repeat itself? All right, so just terminology. Let's staying on this. Now we got to make sure you know the demand curves, supply and demand type of curves, okay? So when we're talking about the supply and demand curves, what we're looking at right now is page 3-1. Okay, let me point out a couple of things to you in particular. Down here on the bottom here, you want to know that demand curves are from the perspective of the consumer, whereas a supply curve is from the perspective of the producer of the goods and service. Okay, demand curves are from the perspective of the consumer, so try to kind of keep this in mind. First of all, notice that prices are going up and down on the vertical line. The quantity, which is the producer, lower quantity is to the left, higher quantity is to the right. Okay, so the slope for the demand curve is a downward sloping into the right. There are a couple terms you want to know. Oh, before we go any further, that's your demand curve for a second. I want to come back to supply curve. Supply curve is over here on page 4-2. And on 4-2, supply curves are from the perspective of the producer. And they're upward sloping to the right. You still have your price over here in the vertical, and you still have your quantity on the horizontal line, lower quantity to the left, higher quantity to the right. Okay, so now I'm sitting over, and we're going to come back to some of those other pages that I'm skipping over. we're looking at page, what is it, page 5-2, the equilibrium. And what is the equilibrium? That's this point right here where the lines cross each other. This is the equilibrium point. That's when the most quantity demanded will equal the most quantity supplied, type of a feeling. Now, when it comes, what I've noticed when I looked at the comp exams, or had an opportunity to see some of the questions that were released from the comp exam, I noticed that they're going to, if they want you to interpret a supply and demand curve, they're going to ask you to interpret it in one of two ways. They're going to either talk about the movement, well, there's two different movements, and I'm not an economist, but I'm going to try to put a perspective. There is movement on a line. What I mean by movement on a line, it's moving on this particular line, either going this way or that way. Okay? What I mean by that, if the price went up, and let's say the original price here was $10 a share, and the new price is now $15 a share for that product. So if the price goes up in dollar amount, what do you think happens to the quantity that is demanded by the consumer? The quantity that is demanded by the consumer drops. Okay? So the price is going up, the demand is dropping. And that's shown by this arrow right here on the right that I'm, the demand line is this line right here. This is your demand line. Okay? Price goes up, the demand goes down. The quantity demanded is going down. Backtrack, stop here for a second. The quantity demanded is going down in respect to the consumer. But from the producer's point of view, on the supply line, when the price is going up, the producer supplies more product. So when I talk about demand going down, let's erase this. Start this thing over again. Clear the page. All right, here one more time. Price was $10 a share. Price went up to $15 a share. This is your demand line. Okay, the demand will drop by the consumer. From the supply standpoint, when the price goes up, the supplier produces more quantity. The supply goes up. So this arrow going upward right is representing more quantity being produced. This arrow that's going to the left from the demand side is that they are demanding less quantity. So when you have more quantity produced, less quantity demanded, causes you to have what? Excess supply. That make sense? Price went up, the demand went down, the supplier made some more product, causing an excess supply. So they want to bring that price back down, they have some sales. Okay, that is, they call that a movement determinant. Movement on the line. Movement on the line is caused by price changes. It moves up and down these lines. Think the same scenario. price was at 10, drops down to $8 a share. The demand increases, right? Demand, it's increasing from the standpoint of the consumer. The supplier says, hey, price is going down, I'm not making as much. So less supply is made available, causing what? An excess demand. So watch for the question that might talk about price movements. Everything else being equal, if the price movement changes, what happens to the demand from the consumer standpoint? What happens from the supply from the supplier's standpoint? That's called movement determinants. Well, what about the other type of shift determinants? I'm going to clear this page for a second. And now I'm going to talk about the idea of what if we move the demand line up to here. Okay, so this is demand line 1, whereas this one down here was demand line 0. What causes the demand line to shift upward right? What could cause the supply line to shift downward right? What does it do to the prices? Demand goes upward right, shift line goes downward right, that type of stuff. All right, so let's go back, if we could. I'm going backwards now to this demand curve. And what we should come away with on this demand curve is a little bit of an understanding of the factors that impact demand, okay? And it's kind of tough to do this on a whiteboard like this. I'm looking at page 4-1 here, factors that impact demand. You should know the factors that can impact the demand. And we're talking about consumer demand, remember, for goods and services. One of them being that if there's a change in the consumer's income level, does the consumer take that change, let's say it was a change upward, and do they spend that money, or do they take that money and they save it? Do they have access to more credit because of the changes in their income level? Oh, you know, credit companies will up their amount that they can borrow. That can be a factor impacting demand. A change in income level. What if people lost their job? They're not spending. They're not saving. Okay. How about the second bullet point? Prices of substitute goods. Okay. Choices of products. You know, do you want to drink coffee, or are you going to switch to tea? Are you buying plastic pipes or cast iron pipes? Can you substitute other things for what you've had in the past? Prices impacting demand. Complementary goods. All right. These are goods that are used in conjunction with the products. Computers, they need computer chips, right? That's what that's kind of implying there. Computers need printers. Complementary good. Personal tastes could impact it. Buy a Gucci bag or buy some knockoff. Consumer tastes we're talking about, right? Diet trends and its impact. You know, the Atkins diet versus the South Bend diet versus the Krispy Kreme diet. You know, drinking Starbucks coffee or going to Dunkin' Donuts or Caribou or McDonald's or Subway. You know, how are people changing around, and are they spending as much? Those are all different things that impact demand. And what we're talking about here is not necessarily the price. It's not a price movement change, it's a change in income level. What if there was a change in the tax level? What if the government lowered taxes, meaning that the people will have more money in their pocket? If they have more money in their pocket, what do they do with that money? Do they buy down debt? You know, do they pay off debt type of thing? Do they go out and buy that new car finally? Do they buy the new TV finally? Do they buy some new clothes finally? Do they take vacations? Okay, those are variables that impact spending, right? So when those variables changes, those are the variables that shift the lines. So I mentioned to you that there were movement determinants, which is moving because of a price change on a product or a service, is different than a shift change that is caused by anything other than price changes. Does that make sense? So that's your takeaway, folks, at this point. Supply and demand. You should be able to look at a supply and demand curve and determine who are from whose perspective. So you got a supply curve, it's for the producer. You look at the quantity that's on the horizontal, more quantity goes to the right, less quantity to the left. Higher prices go up, lower prices come down. We look at the supply, demand curve, it's from the perspective of the consumer. When the prices go up, the demand decreases. When the prices go down, the demand increases. That's what they're looking for. So you should know about price changes and the impact, and you should know about what changes the movement of the curves themselves. How about the term elastic and inelastic? So I'm looking at page 3-2 of your book. Different demand curves. If it's an elastic demand curve, which means, hey, these are items that we do not need to purchase, I could hold off. So if there's a change in price, I'm not going to buy it. So big change in price, I'm not buying. All right, well, that's different than an inelastic demand curve, which says, hey, man, I don't care what happens to the price. I need the milk for my kid. I need the drugs for, because we got sick people in the house or something of that nature. So items people need to buy, price increases are met with very small drops in demand. They cannot afford to stop buying it. Now, we understand that in the real world, people do stop buying certain things, and they try to find something else to substitute for it. But in essence, this is how it works. So you should make sure you're familiar with elastic demand curve, inelastic demand curve, and how to explain it or how to view it going forward. All right, we already got factors impacting demand. What about factors impacting supply? This is on page 5-1, I believe. Okay, so these are the variables that impact the supply of goods and services. So the product has a current selling price, right, for the various types of supplies of the goods or services. If the level of technology improves, so if it improves, does that mean it's going to cost more, or could it cut the costs? Production costs. Well, what are we talking about in regards to production costs? Remember I told you to skip that first page? Factors of production and corresponding costs. I believe this goes along with that factors impacting supply. What does it cost to make the product? What does it cost to produce the service, to produce the product? There's labor costs. How are those costs represented? By the wages. You have to have property, plant, and equipment. What do you do with those particular prices? They can depreciate that. All right, natural resources. You got to buy some of the chemicals and or whatever else you need to make the various products. You can deplete those natural resources. You got to borrow some money. That's capital. The company has to pay the interest. The cost of the capital is the interest, and they got to pay down. Those are factors that impact supply. So that's why I wanted to hold off on that page. So I'm sorry for the jumping around, but if we look at the idea behind the way this was set up, first couple of pages on inflation and deflation, just for terminology. You look at the demand curve and understand a couple of the key points about it, and elasticity, some factors that affect the demand. Jump into the supply curve, and you know that's in relationship to from the perspective of the producer. What are factors that impact the supply and the costs? We come up with a price that everybody is good at, the equilibrium price, the one right here in the middle, where the highest amount of quantity demanded in equals the most amount of quantity that's going to be supplied. Could we have movements up and down the line? Yeah, those are movement determinants. Can we move the lines themselves? Yeah, those are called shifting determinants. They move the line. Just an example of the 1974 oil embargo that you could read about. We're not going to worry about that right now. All right, so that's supply and demand. Before I jump off of this, I'm going to read to you something real fast. I know I got it here somewhere. Or I had it here somewhere. Let's see, do I still have it? No, I don't have it. Okay, forget it. I'm not going to read it to you. I was going to give you an actual test question that was on the comp exam, and it had something to do what caused the shift in the demand, because of saving money or spending money and things like that. So I'm sorry, don't have that in front of me. Money supply 6-2. Do yourself a favor and make sure you can define and understand what makes up M1. It's the sum of cash, coins, and checking accounts. If we say M2 money is all that stuff, cash, coins, and checking accounts, and you had savings accounts, that's your M2 money. Well, who controls the money supply? And it's the Federal Reserve. Now, when I'm talking about the Federal Reserve, am I talking about the U.S. Treasury Department, or am I talking about the Federal Reserve Department, or the Federal Reserve Board? Okay, you make sure that you are not going to confuse yourself when you talk about the U.S. Treasury or the Fed. Fed is not the federal government, it's the Federal Reserve Board when they use the word Fed, but hopefully they will spell it out. So you need to know that the Treasury, the U.S. Treasury Department, is the budgetary agency of the executive branch that is concerned with the financing federal government operations. How do they finance federal government obligations? That's when they use the Treasury bills, the Treasury notes, the Treasury bonds. Those are the issuing of the Treasury securities. Right? And it's a budgetary agency, the Treasury, the U.S. Treasury. The Federal Reserve Board is an independent government agency that manages the nation's money supply. Here's the money supply we're talking about. Okay? The Treasury issues the debt securities. Remember that. It's the U.S. government that issues the Treasury securities, the bills, notes, and bonds to the general public to finance the budget deficits of the federal government. It's the Federal Reserve Board that buys and sells those government debt securities. Now, there's others that buy and sell the federal, but one of the monetary policies is the open market operations of the buying and selling of the Treasury securities. We're going to get to that in a second. Does the Treasury, U.S. Treasury, determine monetary policy? No, it does not. And it does not determine the money supply. The Fed does the monetary policy, and thus it controls the money supply. Okay? Definition of velocity. You could read about the definition of velocity. Let's move on. So we've got a couple of pages about the Federal Reserve Board called the Fed. You could learn, it started back in 1913. It's an independent entity. How is it made up? One regional federal bank equals 3% of the members' banks combined and all that other stuff. You could read about these different type of numbers. That's just pure reading. How is it governed? 7 members are appointed by the president, confirmed by Congress. They spend an awful long time, don't they? 14-year term, staggered 14-year. FOMC, there was a student that called after a comp exam, a couple of them did, and said, you know, they got a question with the FOMC. Who the heck is the FOMC? Well, it's the Federal Open Market Committee of the Federal Reserve Board. And what do? They're the ones that determine the buying and the selling of the Treasury securities. Open market operations is from the Federal Open Market Committee. So FOMC. You might want to write that down for yourself, because if you see a test question, you don't get baffled by it. FOMC. And if someone never read about the FOMC, they wouldn't know what we're talking about. Okay. Again, you can see how it's made up. Next page gets into the, I'm just going right through the pages here. The different, we're on page, 8-1. I want to back up for a second here. See this number. See this number, these numbers down here in the bottom? Right here in the bottom, the Federal Reserve profits above that go to the U.S. Treasury. So in 2012, the Federal Reserve profits from their buying and selling of Treasury securities. Now, profit is after everything is paid off, right? Just like a bank, like a company. They had profits going back to the U.S. Treasury for $88.9 billion in 2012. In 2011, it was $75.4 billion. 2010 was $81.7 billion. In 2009, $47.08 billion. Are these things talked about? I don't know. So it wasn't like things are bad. It's all the perspective and how they're shown, I guess, and talked about on TV and on the radio and all that type of stuff. All right, so all they're doing here is telling you that about the Federal Reserve. Look at all the pages that were devoted to the Federal Reserve. So maybe there's a reason for all those pages. They want you to know that they're out there. All right. Now, look at the goals of the Federal Reserve goals for the economy. But the economic goals at the Federal Reserve, they look for economic growth. Does anybody know the percentage of economic growth that they would like to, kind of a pace? They would like to see a pace of economic growth of about 2 to 3%. Picked this up out of a book that gave these numbers that the Federal Reserve is looking for. The full employment. When they talk about full employment, what are they saying is full employment? 3% to 5% is considered full employment. So, 3 to 5% unemployment is acceptable. We're moving in that direction, aren't we? We're getting down about 6 point something. It's interesting. We're accepting 5%, but we don't like 7%. Why is that? Because there's more people on your block that are not working? Or if you're the only person not working on your block and you're one of the 5%, you're not happy, but it's acceptable by the Federal Reserve. Can we ever have 100% employment and no unemployment? The answer is never. It's never going to happen that way. And stable prices, which I would believe is probably your inflation, 1 to 2% is their goal. Well, these Federal Reserve goals are the same goals of the federal government goals. They all have it, so, and I don't know why we don't have a page on a slide that says that the federal government goals are economic growth pace 2 to 3%, full employment being 3 to 5% of is acceptable for unemployment, and stable prices 1 to 2% inflation. But they do say it about the Federal Reserve. So I'm just wanting to point that out to you. Now, how does the Federal Reserve move in this direction? They have the monetary policy. What is the monetary policy of the Federal Reserve? Right here, the Federal Reserve policy, Federal Reserve has 3 tools. They impact the reserve requirements, that's 1. They impact and make decisions about the discount rate. That's 2. And they, come on, move this. And the federal, I got something blocking me here, right? The Federal Open Market Operations, which is from the Federal Open FOMC Market Committee, okay? And that's the buying and selling of U.S. Treasury securities. Oh, there it is. It's conducted by the FOMC. See it? Right here. All right, so those are the 3 Federal Reserve Board's tools. What do they do with those particular tools? If they want to expand the monetary policy, they want to improve on it, they said to the banks, we're going to lower the reserve requirement, how much money you have to keep on, at the bank. If the banks had to borrow, they will lower the discount rate for them to go ahead and borrow some money. And if they want to expand, the Fed is going to go out there and buy Treasury securities. If they buy, they put money into the system. If they put money into the system, then the system will lend out that money. What's the net effect right here on the bottom? The net effect is the expansion of the money supply. Because if there's more money available, the interest rates are lowered, and it could impact the raising of the stock prices. In other words, stock prices that were coming down might be turning around and going back up a little bit. That's expansionary monetary supply. Well, if there's an expansionary, there must be a contractionary. And the contractionary would be the opposite. If they want to tighten it, they will raise the Federal Reserve requirement. They'll raise the discount rate. They will sell the securities. If they sell the securities, someone's got to buy it. If the banks have to buy it, they take money out of the system. So what's the net effect? It's to raise interest rates, slow things down. That's your monetary. You need to know about the monetary policy of the Federal Reserve. Okay. Now, I'm going to get to this GDP in a second, but let's jump over to fiscal policy, because that would make sense if we knew we have the Federal Reserve policy. Well, what's the federal government's policy? It's called the fiscal policy. At one time, there was only 2 of them, taxation and government spending. And then, I don't know how many years ago, they talked about deficit spending and things of that nature, and it came in as a fiscal policy, the management of the borrowing of the money and the repayments of debt, and so on and so forth. Okay? And I'm saying to you that back in the early 80s, we only talked about 2 fiscal policies. The federal government raising and lowering taxes for both companies as well as personal, the personal income tax levels. They're the ones that make the decision to raise or lower the tax rates, right? They're the ones that are going to determine what to spend or not to spend. So how do they expand the economy? Well, the government will start spending money. If they start spending money and creating jobs, which we saw that happening, a couple of years ago. What happened in the last couple of years is a great example of fiscal policy and what was taking place, as well as monetary policy in action. Almost every day you can read something about fiscal policy and monetary policy taking place out there. And so I think your takeaway from this is that you better be prepared to, when you're reading a question, to look. They might give you an underlying economic cause and ask you what would be the possible fiscal policy change that could take place. For example, if the current economic expansion is causing an increase in income tax collections, with tax collections exceeding government expenditures, the possible fiscal policy change would be maybe individual income tax rates get reduced, because if they're bringing in more money than they need, they could lower the tax rates. And to lower the tax rate, it has to come from Congress, a law passed by Congress and signed by the President. Those are things that you should make sure you understand about fiscal policy and about monetary policy and what goes on. Okay, now let's back up a little bit. In moving away from monetary and fiscal policy and getting into this stuff about GDP. Okay, this GDP is on page, let's see, where are we here? 10-2. Okay. This first bullet up here on the top is your definition of GDP. It's the total output of new final goods and services produced within the nation's borders, regardless of what nation owns the production means. They used to, instead of calling it the gross domestic product, back in the old days, they used to call it the gross national product. And they defined it as, so much, what's made here in the United States, but if it's made across here, we include this here and take away this over there, and it got confusing, and then there was all that uproar about, hey, should be buying just stuff made here in the United States. So they finally moved away from the GNP term and called it the GDP term. And as you can read it, total output of new final goods and services produced within a nation's borders, regardless of what nation owns the production means to do it. So if Germany has a company here in the United States and makes the product here in the United States, it counts in the GDP. Okay? Now, what about the formula for GDP? The formula for GDP is the consumption plus investments plus government spending plus net exports. Bottom line should equal 100, right? I think that's how they... So let's see. How does this add up here? 71, 81, 85, 95, 105 minus the 5 is 100. Okay. Your job is to understand how big is this consumption, the consumer part of the GDP. Notice the percentage. When they talk about investments, they're not talking about investments that you and I make. They're talking more about business investments. They do have the word individuals in here, and that makes a very small part of it. It's the business investments in buying more equipment, buildings, land, so on and so forth. Then government spending, things of that nature. Okay, so keeping that in mind, we'll come back to this page here about balance of payments. Business cycle. This business cycle is located in 12-1. Your job is to understand what's going on and to interpret what's going on. Notice the business cycle. Okay? And so this implies this goes this way, and then eventually this is going to come down over here. Okay? Business cycles are not equally the same length of time. You understand that? All right? Let me do this. I'm going to get a new page here. Okay. Okay. This period down here, we should know it as the trough. When you're coming out of the trough, you're starting to do what? Expand. I'm just going to use the letters EXP for expanding. That's the beginning stages of expanding, maybe the mid stages, the end stages of expanding, and eventually we get up here into the peak. And after you hit the peak, you start to do what? You start to contract. How about CONT for, let's go all the way, contract. Contract. And eventually you come back down into the trough. Okay. So, with that in mind, you need to do yourself a favor and kind of get and maybe find some books on this. I know that the slide here, nope, not the slide, talks about expansion, contraction, trough, recovery. Where does recovery take place? Expansion, where does it, those are terms that it used. And understand that there are basically 4 major phases of the business cycle. What are the major phases of the business cycle? And not like this or any special order, but we'll call this one here phase 1, the trough. Phase 2 is expansion. Phase 3 is peak, and phase 4 would be contraction. Okay, so when we're in phase 1, the GDP is what? What happens to GDP when we're coming down out of, from this contraction down here into the trough? The spot right here coming down into the trough. Your gross domestic product is down during that time, isn't it? So I'm looking from the supply side. GDP is down. So your industrial production is down. And if we said, well, what is industrial production? You might want to learn about some of those terms. It measures the changes in the output of the mining, manufacturing, gas, and electric utility sectors of the economy. That's industrial production. We don't need as much electricity to run the machines. We don't need gas to run the trucks and the tractors and all that type of stuff. We don't need coal. We don't need, we're not mining as much. So if industrial production is down, the capacity utilization is down. Well, capacity utilization. What is capacity utilization? If I was a auto company and I had 5 lines running to make cars, how many cars can I put out per hour, on the production lines? Well, first of all, do I want 100% production going at all times? And the answer is, well, maybe yes I do, but maybe no I don't. So is it the answer yes or no? And the answer is, the government looks at that and says, you know what, we believe the ideal is 80% capacity utilization. And so if you ever read the Wall Street Journal and or those investors, News Daily or whatever that investor other paper is that shows all the charts and all that, when it's at 80, people are happy. The government's happy, the Federal Reserve is happy. 81, they're still happy. 82, they're starting to open their eyes and say, oh, it's heating up. 83, it's heating up. 84, oh, it's getting a little bit too high. 85, oh, we better start tightening it down a little bit because it's getting too inflationary. So you should know about capacity utilization. All right, so if the GDP is down, industrial production down, as capital utilization is down, what happens to the to labor productivity? Those that are working. Hey, they got the good workers in there working, labor productivity is up. Well then, if labor productivity is up, what is the unit labor costs? Well, unit labor costs are down. It's not, you're more efficient people working. So if unit labor costs are down, that leads to what? The producer price index being down. What's the producer price index? It's the prices charged by the producers of finished goods, the wholesale price, selling it out to the retail side. All right. Well, that's your supply side. That's phase 1. Well, phase 1 is followed by the phase 2, which is the demand side. And remember one thing, that CPI, the consumer price index, follows the producer price index. So if the producer price index is down, your consumer price index is down. If your consumer price index is down, your consumer's real income is up. They got more money in their pocket. And if their consumer real income is up, that leads to the consumer sentiment. How do they feel about life, liberty, and the pursuit of happiness? It's up. That's when you get your phone calls. How things are going. Okay, great. I'm going to go out and buy some stuff, all right? And if the consumer sentiment is up, then the consumer demand is up. Well, what is it up for? Auto sales start to go higher. Retail sales start to go up. The use of credit cards goes up. Consumer credit. Housing starts goes up. So, man, things are getting exciting out there. All right, so when we're in, so this supply side down here is occurring down in we call that supply side 1. Demand side is over here. Your job is to say, well, wait, if the consumer price index is down and the consumer sentiment is up, and who is leading the charge in moving the economy? And it's the consumer is leading the charge at that point. That's why if you look at the GDP formula, consumer usually is 70% of the GDP movement, what the consumer is doing. So phase 3, so we're moving up this expansionary here. Well, as we're moving up, the supply side is saying, hey man, there's a lot more happening out there, a lot more buying going on there. The GDP starts to move up. All right. The industrial production is moving up. We need more coal and trees and stuff to do this. And the capacity utilization, we got to hire more people, and that's going up, and we're filling up those things. But what happens then when you hire all these people? Your labor productivity starts to go down a little bit. Your unit labor costs start to go up a little bit, thus leading to your producer price index going where? Up. Okay, and that's occurring, as we move up here into the peak and all that. Well, man, at that point, what happens to the demand side? As you can see, the supply is followed by the demand, followed by the supply, followed by the demand. The CPI is going up. The consumer price index is up, which means that the consumer's real income is going where? Down. They don't have as much money. And if that's going down, it leads to their consumer sentiment going down. They're not as happy. They're not going to be spending as much, which means that their consumer demand is going down. And if their demand is going down, what is it going down for? These 4 things start to go down, the sales. Okay, and then we start hitting the contractionary time. So I said all these things to you, try to put it into a perspective, and I'm going to go back to that slide here, and look what is said on the slide here. If we're in the expansionary time period, and there's different phases of the expansionary, what is happening to inflation? Maybe at the beginning it's low, but maybe it starts to come up a little bit. Interest rates low at the beginning, and then eventually starts to come up. Stock prices are lower and are starting to really come up. Corporate profits are increasing. Hard assets are, what this is showing here is, whoever put the slide together is saying you should be aware of these things happening during the expansionary time. But if we start the contraction, the different phases of the contraction, what happens to these various things of inflation, interest, and we're in the trough, what is happening? So there's some some thoughts to that. I want to go to the next slide here and say what I had just said to you. If there's changes in the GDP, industrial production, and capacity utilization, whether they're going up or going down, how does that impact inflation and deflation, interest rates? What's happening with employment and unemployment during the various parts of the business cycle, the productivity of the unit labor costs and unit labor productivity, credit access, what's confidence, consumer sentiment and stuff like that. Again, factors in the business cycle, various types of pivot points. All right, so where are we going with all this? They might say to you, here's the situation in the economy. What would be something that you might recommend for your clients on investments? What's happening to real assets during this particular time? Okay, there are various companies that have explanations of this stuff that you could purchase when you're getting into studying for your comp. If not sooner than that, you might want to be looking at some of these books or materials that give you some of these things. Great example in the recovery phase. Okay, well, what's the recovery phase? Well, maybe the recovery phase is coming out of the trough into the beginning phases of the expansion. There was a gentleman by the name of Michael Lehman back in 1981-82 when we were taking our course on the introduction to the financial planning and stuff like that. We had to read a book. It was called How to Read the Wall Street Journal. Okay, Michael Lehman wrote it. I thought it was a great book, very relevant. He used to call phase one the trough to recovery. Maybe phase one is just purely trough. He calls it trough to recovery. And that's when he went through the GDP, is down, industrial production down. And then when you came out of that phase one which was the supply side, into the demand side, phase two, he would call it recovery to expansion. Every time he expressed the business cycle, he used two words. We're coming out of the trough to expansion is phase one. We're coming from from recovery into expansion was phase two. Phase three is at the top of expansion going into the peak. Phase four was from the peak going down into the contraction. That's how he expressed it, as opposed to the traditional way of saying trough, expansion, peak, contraction. Okay, just thought I'd let you understand that. Number two, if we're in that recovery phase, here's the point I want to make. If you're in that recovery phase, the economic features, consumer spending leads the GDP equation, because it's the consumers that's heating up. Now, so there's increases in the GDP. Unemployment is high in that trough area, but as we're coming into recovery, the unemployment is starting to decline. People are getting hired. The labor productivity that was, is rising. Remember, you got the good people working, and the capacity is at 80% or so. But it's starting to rise a little bit. Inflation is low at that point. Interest rates are low at that point. So maybe financial assets like fixed income prices are relatively stable at that point in time. Maybe the investors buy the bonds for the yield, not for price appreciation, because if interest rates start going up, the prices will come down. Maybe people who are in long-term bonds might be coming into short-term, dropping into intermediate to short-term bonds. They think things are starting to heat up. The PE ratios are low at that point. Stocks are starting to rebound. People are buying real estate at lower prices. Mortgage rates are low. But now we get into the expansion phase. And what leads the expansion phase is investments. Remember, and I'm talking about the investments of the companies into more materials, more equipment, more buildings, that type of stuff. All right, we get up into that peak and starting to come into the contraction. Who steps in? The play is the government steps in. It says, man, hey, we got to, since everything's starting to tighten down because someone was tightening it up, we got to maybe loosen up and start spending some money. So you have to somehow, and I have to believe there's going to be some questions on this, understand the breadth the magnitude of a business cycle, some key points, some key terms about the business cycle. You have to understand the 4 components of the consumer, the investment, the government spending, and net exports, that type of stuff. Okay, so that's about as deep. We can't go any deeper than that. We don't have enough time. And I did find my question on the business cycles, but we'll hold off. You can ask me about that later on. And I already got 8:02. And where are we? We are. Yeah, let me take a look at where we're at here. We're at leading economic indicators. We still have to talk about leading economic indicators, behavioral finance, and technical analysis. So here's what I'm going to do. If you have to take off, I understand that. I'm going to go through and try to finish the assignment. It's all going to be recorded, so if you have to leave, you can always come back and pick it up, because I want to make sure that we get through all the material today, so that we could start off on Wednesday with bonds, which is section number, or packet number 7. Okay? All right, so let's hit the point here. These leading economic indicators. What's the point here, folks? Be familiar with them. Okay? That's pretty stoic on my part. I'm really kind of giving you some big insight into that stuff. But what I think you need, the way you need to be familiar with them, is that you have better just kind of understand what takes place. You never look at one leading economic indicator and say, hey, this is what's happening in the economy. You have to take a lot of them into account to be able to determine what's going on. Okay? You know, we have 10 leading economic indicators, and I guess there are 4 what they call coincident indicators, and there are 7 lagging indicators. And the only thing that we're going to show you here, based on what's on these handouts, would be the leading economic indicators. And I guess the intent is, you can't rewrite the whole book. So, but be familiar with those leading economic indicators, coincident indicators, and lagging indicators. And I'll talk to you about those coincident and lagging in a second. But some of the things you have to be familiar with would be, how do you interpret these indicators? As an example, when you're looking at an indicator, what are you trying to gain from it? What is it supposed to try to give to you? What is it supposed to mean? Example would be, let's see. So I come up with what I'm trying to say here. Let's see. I had something written down that I can make a nice, easy. No, that doesn't work. Let's take a look at number 4 here. Let's use this as an example. Delivery times index. Okay. Delivery time index, a percent of goods delivered on time. Okay. If this particular index is, if they're saying that it's taking longer to deliver the stuff, is that an indicator of a bullish or a bearish type of a market? Delivery times index it's taking longer to deliver stuff. Bullish, bearish. Yeah, it's bullish. That's the type of things. You have to make sure you can interpret what's going on. Watch for little things like on number 2, they talk about jobless claims versus unemployment. If jobless claims are increasing, does that mean things are going good out there or not so good? Well, claims would be it's kind of big, things are going down, right? More people are out of work, more people are making, are applying for help. Claims are increasing. That's different than unemployment dropping or unemployment increasing. Watch how they word. That's all I'm going to say. You have to be concerned with, what are they trying to tell you from the indicator? And can you interpret something about that particular indicator? That's about as deep as we can get. How much more can I talk about it? When we talk, I mentioned to you there are 4 coincident indicators. Those are also sometimes referred to as concurrent indicators. They kind of move in step with the general economic trends, such as GDP and employment levels and retail sales and things of that nature. Okay, so there might be a number of employees on non-agricultural payrolls and industrial production and capacity utilization, what's happening in those particular areas. If capacity utilization is increasing, which means that they're hiring more people, you can see how that goes along with unemployment. Capacity utilization was at 80, now it's at 85. That meant they must have been hiring people, right? If they're hiring people, that's going along with why the GDP is rising and the employment levels unemployment levels are decreasing and employment levels are increasing and retail sales are increasing. Okay, that's a coincident type of an indicator. It's occurring at the same time. The one previous when I talked about these 10 on what's on the screen are leading into the future a little bit. Lagging indicators are economic and financial market indicators which tend to change only after the economy has already changed. The book value of a business isn't determined until after the fact a little bit. CPI, the change in the CPI for services comes, remember CPI follows PPI. The ratio of consumer credit outstanding in comparison to personal income. They don't know it until all the money has been borrowed, then they compare it up against, they're looking back at the numbers and they can make a statement based on what has happened. So there are indicators that are discussed, and this usually occurs like 6 months, couple of quarters, that trail what has taken place. So if the coincident indicators are concurrent with what's happening in the marketplace, lagging or 6 months after, it implies that the leading economic indicators are occurring a good 6 months or so, 6 to 4 months before it really things are being able to be viewed and saying, gee, look what's happening out here. The market, they always talk about the stock market has already made the prediction and has already made their movement 4 to 6 months before we start to really see what's really happening out there. What do they know that we don't know? Type of thing. And so that's why when you go back to this picture here of the business cycle, Let me clear off this page for a second here. So you got this business cycle here. They talk about the investments world moving 6 months before all this happening. So it's, what's happening in the investment world is not exactly what's happening in the business cycle at the time it's happening in the business cycle. It's already predicted that. Saw that in a book just recently where they superimposed the investment cycle of what's happening up against a business cycle, and it looked like what you see on the screen right now. That was pretty interesting. All right, so all I can say to you is your takeaway on these economic indicators is that you be familiar, try to understand them a little bit. How many questions are going to come from it? You remember I said to you, there's 185 questions, and 36 or 40 of them are investments, and you got an 800 or 900 page book to work from. What are they going to zero in on? Who knows exactly? All right, let's move off of economic indicators. What's coming up next here? Yeah, you can read about consumer confidence indexes and what people feel. Just imagine these University of Michigan sentiment surveys, when they call you at 5 o'clock while you're eating dinner and they want to ask you how you feeling about life, liberty, and the pursuit of happiness. How many people just hang up on these people? But they still do them. All right. Industry life cycle analysis. Hey, it's just a point that if you're investing, if it's a brand new industry out there, if it's kind of an up and coming industry, when the tech thing started back in the early, when we had that tech bubble hit, technology, that's something. There's always been technology, but there was a point where it was emerging and it was really growing, and a lot of companies were getting into it, and then eventually some of the companies that were getting into it got bought out by the other companies, and the big dogs stayed around, and then the growth wasn't as rapid, and then eventually it matures, and eventually it starts to fall down, and or those that are still good are going to keep it running out. So you could just kind of read a little bit about that industry analysis. I think they have a page or two about that in your book. They don't hit on it real heavily. Earlier I mentioned defensive industries, so they're just giving examples down here on a defensive industry. Food, tobacco, prescription drugs, those are things that people need all the time. Cyclical. You remember when when the business cycle starts to heat up, people are starting to buy the autos and the housing, those are cyclical. So when do you want to get into? Early, of course, and then get out when after it starts to go the other way, so on and so forth. That's just terminology. Behavioral finance. This is interesting. This behavioral finance. What's the takeaway on behavioral finance? I tell you, there's more and more books about, being written about behavioral finance, and I think the takeaway in this, and Mayo covers it in 5 or 6 pages, pages 412 through 417, is his discussion on behavioral finance. In general, people are starting the study of how people make investment decisions. That maybe don't follow exactly along the lines, or, why do they make decisions, how they make it, how do they feel about the ups and downs, are they averaging up, averaging down, stuff like that. I believe my job in this business is to manage client expectations. I can't control the markets. I can't predict which way the markets are going to go, and if I did, I'd write the book on it, but no one can predict it, and know exactly what's going to happen out there. But I could make sure that my clients understand some things about it, and take care of the misconceptions and the myths and all that stuff, and kind of support it and show them some research that supports certain things, and not try to guarantee anything above and beyond the idea that, how much risk do you want to take? And so my job is managing client expectations, I believe. Well, if we go through a couple of these different pages, well, someone that writes these books are coming up with different terms. Recency effect. Okay, what does that mean? Overconfidence, what does that mean? Confirmation bias. All I can say to you is that, in this behavioral finance, there's a cognitive bias and there's an emotional bias. Cognitive, what does that mean? Is there some knowledge break? Is there something that we can look at statistically, or that's got some factual things that like the old rule of thumbs? That's a cognitive type of a bias. They may not be factual, but live by the rule of thumb. Let's see, based on your age is how much life insurance or how much you should be in the stock market. So if you're 7 years old, spectrum, how much you should be in your bond market. If you're 70 years old, 70% should be in bonds and 30% should be in stocks. Well, who made up that? Maybe it's good, maybe it's not. Maybe it's, again, do they understand risk? And then you can determine how much should be in bonds and how much should be in stocks and things of that nature. So they came up with these different terms, and I can never remember what one term means over another. But but could you walk away with an understanding that people could be overconfident at certain times and not as confident at other times? Markets are going hot. And so somebody was successful, and they believe, hey, they're always going to be successful. Humans get overconfident, maybe when they should maybe be drawing back a little bit. If they, it's like being at a casino table, and you're winning. Well, I'm always going to be winning. There's that overconfidence or stupidity. What do you call it? I don't know. But I can't sit here and go through every term with you. Your job is, I guess, be familiar with some of these terms. The emotional bias, taking actions based on feelings instead of on fact. And I guess cognitive and emotional overlap also. So maybe you can't tell one's cognitive, one's emotional. What can I say about this? Herding. People love to invest in that which other people are investing in. They're following the herd. You hear those expressions being made. Hey, everybody I talk to is in the stock market. How come you don't have me in the stock market like everybody else? Well, because you don't want to lose money. You told me I don't want to lose any of my money. And I want always to have my money, and I want to make some money. Okay. But I don't want to ever lose money. Well, then you can't be in stocks. There's no guarantee in stocks. But the neighbor's making money all the time. What do you do with a client like that? All right, anyway, herding. People love to invest in that which other people are investing in. Humans tend to lack independent thought. Helps explain why people cannot wait to buy stocks after the market goes up a few thousand points, and why often they sell at the bottom. Herding. Isn't the odd lot theory a little bit of the herding, or a version of herding? One of the versions associated with herding. Someone finally gets in, they buy at the top of the market, and then it starts to come down, and then they don't know that they should be getting out, and they don't get out, and then finally, after they lost an awful lot, they finally get out. When they start to get out, other people start to get back in. The odd lot theory, herding. So there's not much more I can say about behavioral finance. It's a concept. It's got a whole bunch of terms. There are many more terms than what you see on these 3 pages. And your job is just to get a feeling for it, and don't lose too much sleep over it. I went online and and printed off things on, let's see, behavioral finance is the new area of financial research that explores the psychological factors affecting investment decision. It attempts to explain market anomalies and other market activity that is not explained by the efficient market hypothesis. The fundamental basis of behavioral finance is that psychological factors or behavioral biases affect investors, which limit and distorts their information and may cause them to reach incorrect conclusions even if the information is correct. The fear of regret, the fear of conservatism, belief perseverance. I mean, again, I'm looking at different terms that we don't know anything about. Narrow framing, forecasting errors, lack of due diligence. You know, so you could find, all I'm saying is you could find a lot of different terms associated with behavioral finance. Take it as deep as you want to get it. Be aware of it. Do more reading about it. Try to recognize your clients. Go to the casinos and watch people and come up with a lot of different behavioral finances associated with investing money or gambling money. Hear the terms that are used at the gambling tables, and you'll start to smile and say, you know, where are they coming from? You know, what is mental accounting? Heuristics is another term that's thrown around on this stuff. So take it as deep as you want to go. Technical analysis, you know, there was a lot of stuff on fundamental analysis. I mean, I'm talking about pages and pages and pages of materials on fundamental analysis. So then they get to technical analysis, and there's only a few pages of information. Okay? So what's your takeaway on technical analysis? First bullet point says, technical analysis uses historical price movements. They look back at yesterday's price, the day before's price, the last week ago, a month ago, a year ago. They look at the volume of today and the volume of yesterday and the day before, and they forecast into the future what's happening, what's the trend. So they focus on the stock, not the company. They don't do ratio analysis. They are concerned about price and volume data. Second bullet point, they look for the supply and demand issues. How do they interpret the supply and demand? Volume of buys and sells. Market volume. Is it bullish? Is it bearish? So, see that point up here in that first bullet point, the forecasted direction? What are they looking for? They're looking for the trends in stock prices, or in the overall market as in general. They're looking for price movement, historical price movement, the direction, things of that nature. What are the different ways they do this? Third bullet point, they use figure, they have a variety of graphs, figures, charts that they are looking at. So I got written down here as a note, technical analysis makes decisions based on the examination of past price and volume data. They determine trends from which they predict future behavior. In other words, they use past performance to predict future performance. They apply these various techniques to the market as a whole or to the individual securities. Contrast that with fundamental analysis. Fundamental analysts attempts to determine a security's intrinsic value. What price are you going to be willing to pay for it, to determine if that security is overvalued or undervalued. Technical analysts analyze historic stock price data for past price patterns. The goal is to predict the beginning of future price movements or trends. In other words, fundamentalists try to assess the true value of a stock, assuming that the market price will eventually adjust to the intrinsic true value. Technicians in technical analysis try to predict the movement of the stock and don't care about why the price will move. They're not concerned about it. The emphasis is more on man, when to buy it and when to sell it. All right, so going from that theoretical idea of technical analysis, here's a sample of a point and figure chart, and they're looking for trends. They have resistance lines and support lines, and those are terms that they would like you to be aware of. It doesn't want to break through the resistance line, and the resistance is upward, right? And eventually they will break through, and it's showing something that's going to support line is on the downside and the bottom going downward. There are a bunch of theories they want you to know about. How many? There are 14 theories that you should know in technical analysis. 14 of them. One of them is the Dow theory. Right? They give you a little explanation about the Dow theory. Second bullet point, the basic concept the basic concept measures the stock prices such as the averages indexes, and that they should be moving together. You got the Dow Industrial, the Dow Transportation. What's the trend? What's the movement occurring under the Dow theory? Barron's would deal with bonds. Dow deals with the stocks. Barron's deals with the bonds, and they give you an explanation about them right down there. Odd lot theory. You might say, well, I could read that stuff. It's based on small investors being wrong, so on and so forth. Well, maybe you need to put it into a perspective. All right, let's take an example of an odd lot theory and put it on this white page here for a second. In the odd lot, all right, so when they do this odd lot theory, and if you read about it, or maybe, I don't know if exactly if it's stated in the book here or if I got this from some other example, but okay, the number of purchases over the number of sales. So how about PURCH, purchases, and this will be for sales. And these are odd lot purchase and sales. So what is an odd lot? Because this is the odd lot theory. Odd lot. Round lot is 100 shares. So this is the buying of not round lots. If you buy 44 shares, it's an odd lot. If you buy 50 shares, it's an odd lot. It's not 100. 100 is round. Anything that's not 100 is an odd lot. Okay. So you take the number of purchases over the number of sales. So let's say we had 60 purchases and 100 sales. Okay, so we're at a 0.6, right? And then then you had 70 over the 100. We're at a 0.7, right? Well, you can keep moving up the ladder. So maybe you had 130. I'm going to keep the sales at the same. Over 100, and now you're at a 1.3. Okay, so I guess, what am I saying? I got down here 1.2 to 1.3 in more purchases. So if we had more purchases occurring, we'd have a higher ratio, right? If we had more sales than purchases, we'd have a lower percentage. And what can you interpret from that? Odd lot theory is a contrary opinion rule. There's contrarians out there. Contrarians are those that go opposite what the consumer is doing. So the odd lot theory is a contrarian opinion type of rule, and they believe that these small investors are going to be doing something wrong based on, as you can see on this top bullet point here, based on small investors being wrong. Okay, so if there's an increase in odd lot purchases, so when that number gets to be 1.2 or 1.3, because you remember your purchases are on the numerator, your sales are in the denominator, if the odd lot purchases number is getting larger, the contrarian looks at it as a bearish situation. They're buying, contrarian is selling. If the odd lot short sales is bullish, there's more sales than there are purchases, meaning the consumer is out there selling, think it's going to drop, selling. The contrarian goes in and buys. That's what that's all about. Okay. The short selling theory, also a technical view. It is also a contrarian opinion rule. Try to understand what they're asking about on the short selling theory. So again, there's investment advisories, your fifth one, put-call ratios. Think about that, put-call ratios. Sometimes you could just look at the ratio. Puts are in the numerator, calls are in the denominator. Okay, so if that's the case, if the puts are in the numerator and we had 70 puts sold, purchased, and in the denominator are the calls, and we had 100 down there, again, to make it simpler, you have a 0.7. If we have 130 puts, which means what? People are buying puts, they believe the prices are going down over 100, and you got a 1.3. Which one is bearish? Which one is bullish? Okay, so if you track the number of call options on a stock versus the number of put options, it is bearish on the right-hand side, right? Because you got more puts over the calls. It's bullish over here when you have more calls than puts. Just a matter of looking at it. Again, a contrarian opinion type of a rule is followed. So do yourself a favor and look at these different technical analysis theories and see if you could interpret it. Because I could believe, and I mentioned there was 14, this advanced decline is number 7 in the list. Here's 8, 9, 10, 11. They don't even give you discussion on it. 12, 13, 14. Those are your 14 different technical analysis theories. What's your takeaway? If someone said, do you know the difference between fundamental analysis and technical analysis? You should be able to say, yes, I do. Technical analysis are the theories and technical analysis, and there are many of them, are based on price volume, price changes, movement in the markets, trends in the markets, looking at past performance, past numbers, past movements, and predicting the future. And the technical analyst doesn't get into kicking the bricks and talking to the people who are running the companies. They're not looking at financial statements and analyzing the ratios and things of that nature. And then they have walkaway theories based on, the small investor and their opinion and how they do things, and if you're selling at the wrong time or buying at the wrong time or whatever the case would be. Whereas if I'm dealing with fundamental analysts, I know that they like to get more in tune with determining the proper price that they would be willing to buy and sell a stock for, so on and so forth, or a bond. So that's your takeaway, I think, at this point. I mean, you're not economists. I think they want you to understand the basics. All right? And I'm calling it quits at 8:36. And I think those of you who stayed around, thank you for putting up with me. And I have nothing else to say. Anybody have any questions, comments, concerns? I hope you caught up in your reading before, and I hope you're already maybe reading ahead a little bit and you're ready to go in bonds. Be a bunch of calculations that we're going to have to do over the next couple of classes on how to solve for yield to maturity, yield to call, duration, things of that nature, changes in prices, and so on and so forth. Bonds are a little bit easier than stocks, just terminology, but it's not as heavy as we had to go into stocks. And I wish we had more time to do more on stocks, but you know, we do what we can. If there's nothing else, I thank you for showing up, and I'm looking forward to seeing you guys on Wednesday. Y'all take care now.